You often hear stocks and bonds in the same breath, and while I've covered stocks, or specifically index funds, quite a bit here on the channel, I have yet to discuss bonds. And
Name's Bond. James Bond.
all 007 jokes aside, there is really nothing super mysterious about bonds. In fact, they're an incredibly safe method of investing. Although, that isn't to say they don't have some cons either. My name is Kim, and in this Finance Spark video, we'll go over the basics of bonds, what they are, the good, the bad, and why you might want to add them to your investment portfolio. Are you ready? Let's go! When we talk about bonds, these are loans from an investor, i.e. you, to a borrower, such as a corporation or government. The borrower uses the funds to support the company's activities. At the same time, the investor earns interest from the investment. A bond's market value might also change over time. Look at it this way. If you have ever given money to a relative or a friend, you have likely invested in a bond. The difference is that there was no official agreement between friends and family members. It was through an informal understanding. In the financial world, a bond is just a loan that you offer to someone in exchange for interest. Bonds are a formal legal agreement between the lender and the borrower. It is permissible to legally take possession of the borrower's property and sell it to recoup your investment if they file for bankruptcy. This is why bonds are thought to be a safer investment than stocks. Stockholders will only profit if the company does, but they'll also lose their investments if there is no capital gain or the firm goes bankrupt. That is only the tip of the iceberg. Another major difference between a stock and a bond is that a stock is a personal investment, while a bond is a loan investment. When an investor buys stocks, they become part of the owners of that business. If a shareholder purchases a bond, you are making a loan to the corporation in return for quarterly interest payments. If a firm files for bankruptcy, stockholders have no legal remedy. However, bondholders can still recover part of their investment by selling off the company's assets. Stockholders will get rich if the company has huge financial success. If you are a bondholder, you will only get the interest and principal payments, and not share as much in their growth. When investing, it is generally better to put money in stocks rather than bonds. Consider Amazon. Amazon issues both bonds and stocks. If you admire Amazon as a company, you can purchase Amazon stock or Amazon bonds. You own a piece of Amazon if you purchase shares. On the other hand, buying Amazon bonds makes you a lender to Amazon, but its corporate bonds are currently at 2.7%. It's reasonable to assume that investing in a company's stock will usually be far more profitable than doing so in its bonds, but it comes with downsides too. So, the next question you may have is, how do you pick the bonds to purchase? The two primary factors you should consider when buying bonds are creditworthiness and yield. Your willingness to trust the borrower to pay their debts depends on their creditworthiness. When investing in bonds, creditworthiness should be your top priority. As long as a borrower is credit qualified, you are legally assured to collect both the principal repayment and the interest. As a bond investor, you should always do your due diligence on the borrower. Also, make sure you only invest in creditworthy bonds. If the borrower goes bankrupt, you either get your money back or not. To ensure that it is creditworthy, check its credit rating. Credit ratings are scores that are calculated and published by independent third-party agencies that help you determine how trustworthy a borrower is. AAA is the highest rating for a bond. It is thought to be an extremely safe investment with almost no chance of default. The lowest rating for a bond is a C. This indicates that it is already in default and at the bottom of the scale. As for the intermediate ground, everything BBB and above is regarded as investment grade, and anything below it is regarded as a speculative or junk bond. So, as a bondholder, you should always hunt for investment grade bonds. Tesla, for example, is currently at a BB grade. That puts it in the realm of speculative bond investments. The yield is another factor when evaluating bonds. The yield indicates how much profit you are generating on a particular dollar amount invested. If you put $100 in bonds with a 5% yield, you may expect to receive $5 of profit a year. Naturally, a larger return is preferable. Are you one of those investors seeking for greater return on investment? Well, then listen to this. In bonds, bigger returns also carry higher dangers. A 20% yield is undoubtedly superior to 5%, but any bond providing a 20% yield should be viewed with great caution. Why should you be cautious? Well, before I tell you, I should mention that if you're intrigued about bonds and other investment topics, then don't forget to subscribe to Finance Spark, where we release videos every week to help you spark your financial mindset. Also, hit the like and bell icons to be notified when we post a new video. Okay, so let's use Turkey's government bonds as an example. It is currently predicted to have a 21.59% yield. If compared to US Treasuries, which are yielding at 3%, Turkey can attract a lot of bond investors, but it has a credit rating of B+, which belongs to non-investment grade. This means that Turkey's government bonds has a higher chance at default. While US Treasuries does not have a high yield, it has never defaulted on any of its obligations. Even if the return on Turkish bonds are quite attractive, there is a chance that you won't get your money back. This means that a greater yield does not guarantee credit quality. Lower credit worthiness is associated with higher yields, and vice versa. A 21% yield sounds too good to be true. So, the closer a borrower is to a junk bond rating, the more cautious you need to be. When you have decided to buy bonds, you can purchase either a bond fund or an individual bond. A bond fund is created when different bonds are bundled together, sort of like index funds with stocks. These include hundreds or even thousands of bonds, and the great part is, you can easily buy everything at once, and the diversity offered by bond funds is a plus. Your credit risk is distributed among the many borrowers when you use a bond fund. To do this, you must have some kind of investing account or brokerage account. The most effective locations to accomplish this are at Fidelity, Schwab, or Vanguard. If you want to know more about these financial institutions, check out my video on the top 5 places to open a Roth IRA. I will leave the link in the description box below. Consider the Bond Exchange Traded Fund, or ETF, LQD. LQD holds more than 2,000 different bonds. It is a widely diversified bond fund that distributes its credit risk over a wide range of borrowers. If one of those 2,000 bonds fails to live up, it will not have a significant impact on your investment. It is safety in numbers. Compared to purchasing individual bonds, bond ETFs or bond funds make it easier to invest. I posted a video all about ETFs, index funds, and mutual funds, which you can check out from the link in the description or by clicking on the card above. It makes more sense to stick with investing in bond funds than picking out individual bonds because of the investment minimums requirement. These generally start at $1,000. You also need to pay some fees and commissions when using a brokerage firm. While researching various bond funds or even individual bonds, you will encounter government bonds and corporate bonds. Government bonds are obligations issued by the federal, state, or local governments. One particularly well-known example is the US Treasuries. IEF is a bond exchange-traded fund that invests in US Treasuries. By comparison, LQD that I mentioned a moment ago focuses on corporate bonds. Since corporations are more susceptible to bankruptcy than governments, the yield on corporate bonds is greater than the yield on government bonds. For instance, the yield on the US government bond fund, IEF, is now about 0.59%, but the corporate bond exchange traded fund, LQD, has a much higher yield at 2.25%. So, government bonds have lower yields than corporate bonds. A while ago, I mentioned that credit quality and yield are indirectly related. If the yield has a greater percentage, its credit rating might be at default. It is better to stick with government bonds if you are unsure of your bond investments. That was a lot! Great job on making it this far! Just remember that a bond is a loan that you give to a borrower in exchange for interest. It is bound by a legal contract between the lender and the borrower. It is thought that bonds are safer than stocks because you are guaranteed legally to receive at least your interest and your principal as long as a borrower doesn't go bankrupt. When choosing which bond to invest in, consider not just their yields but also their credit worthiness. Credit ratings can be used to determine credit worthiness. A AAA rating has the safest, while C ratings are the riskiest. You should carefully balance bond yield with credit worthiness because the riskiest, least credit-worthy bonds typically pay the highest yields. If you're a beginner, choose bond funds since it is convenient, cost-effective, and diverse. Through bonds, you can diversify your investment portfolio. So, as you can see, you might not want to have bonds be the majority of your investment portfolio, but they can definitely be a great strategic tool to use alongside your other assets. Are you a fan of bonds? Do you use them heavily in your investment plan? Share your thoughts in the comments below. That's it for this Finance Spark video. Hopefully, this helped you spark your financial mindset and provide some financial food for thought. Until next time, thanks for watching.